Hi, welcome to MonsterMortgage.ca. Today I'm with Christian Harris, and we're going to talk a little bit about how to pay down a mortgage quickly and do it in your own control. So you'll control when you'll do it and how you'll do it. So I'll pass it over to Christian to talk about what he refers to as the Mortgage Terminator.
Yeah, the Mortgage Terminator is a bit hokey, but it's all to do with amortization. And a lot of times when I meet with my clients, we spend some time talking about amortization. Most clients, most people understand amortization is the life of the mortgage, so how long it'll take you to pay off a loan. Obviously, the higher the amortization, the lower the payment. And in Canada, you can have an amortization up to 35 years. This was increased from 25 years about 5 or 6 years ago to help Canadians be able to afford homes as house prices have increased drastically in the last 10-15 years. So what we like to talk about is the amortization and registering it high. And there's a few reasons for registering it high. One of the main reasons is basically when an institution, a bank or a lender is giving you money, rates are historically low, you do want to be able to control what you do with that money. All mortgages today are designed, or most mortgages are designed, where you can pay them down very rapidly. There's very aggressive prepayment privileges. So it's nice to have the option to have a lower payment if that's what you want. 35 years, the difference between 35-year amortization and a 25-year amortization on an average mortgage of $300,000, let's say, is about $250 a month. So what I like to talk to my clients about is basically to register an amortization for the highest that the lender will give it to you. So you have control of your money, what you want to do with it, and you have other options.
What are some reasons why you'd want control? Give me an example.
Change in family status. Maybe there's maternity leave, where the income coming in is not as much as it was for the for a year period or so. Temporary job loss. A very popular one right now is investment properties. A lot of people, especially in the Toronto area, first property they buy may be a condo. Second property they purchase, instead of selling the first property, which a lot of our parents did to buy the next property, they're holding on to them as investment properties. And by having a high amortization registered, you can go back to the highest amount that the lender will give you. It gives you flexibility with, obviously you're writing off the interest, so you don't mind that.
Yep.
And if you're depending on rent to pay the mortgage, you want to make sure you have some flexibility.
Sure, you increase your cash flow, right?
Absolutely, yeah.
So we put on the board here an amortization schedule. On the left side, we've maximized it to 35 years, and the right side is the term. So generally, mortgages are made up of a bunch of different terms. Back in the day, we used to refer to them as different periods, like in a hockey game. But now, with the extension of the amortization to 35 years, people are taking sometimes longer. But we're here to show you how to pay it off faster.
Absolutely. The Mortgage Terminator is just about essentially increasing your regular payment once a year.
Once a year.
So it's avoiding lump sum payments, which
okay.
most Canadians don't do. So once a year, increasing your payment and by a certain percentage.
Okay, so let's look at a 5% increase to start with.
And this is on a $300,000 mortgage.
Okay.
A 5% increase bi-weekly would be about $35 every 2 weeks.
$35 increase every 2 weeks. I think most people could afford that. Now, what does that reduce the amortization by? From 35 years down to what?
Just under 17 years.
17 years. Okay.
So more than half the mortgage.
Okay. And from a regular 35-year term, if you waited at 35 years, what's your interest savings?
It's about
by doing that increase.
It's about $124,000.
Okay. So for this initial term, we're talking about $124,000 of interest savings, simply by increasing your payment by 5%.
Correct.
Now that's each year.
Each year,
Yeah.
by 5%, which in this example is about $35 every 2 weeks.
Okay, so that's just that number. And if we increase this by 10%, is that a realistic increase bi-weekly?
Yeah, I mean the lender's allowed to go up to 25, so we're being very conservative here. But a 10% increase every year on this size mortgage would be about $68 every 2 weeks.
$68, and again, at the end of the first year, you're going to increase that by 10% again. So there's a
every year
mounting effect. That must cut the amortization down further to
about 13 years.
13 years. Great. And the extended, the interest portion of this, combined with this,
Will be about $151,000.
$151. And let's just do one last example. Let's say 15%, which might be manageable for people as well.
Yeah, 15% every 2 weeks would increase your payments by about $103.
Yeah, $103. Okay, again, that's bi-weekly. And what kind of difference does it take us down to here?
Brings you down to about 11 years.
Okay, so obviously the amounts, as I said earlier, aren't changing as quickly because at this point you're predominantly paying off the principal.
Correct.
And your interest savings have occurred early on. So that total amount of the three of these, for the last example,
It's about 166,000.
166. That's after tax money. That's example 1, 2, 3. One of the other benefits of this is that, I mean, you're really limiting the amount of mortgage renewals and terms you're going to be exposed to in the marketplace, right?
Correct.
I mean, right now, the example out there is variable rates are low 2s, 5-year fix is around 4%, but 5 years from now, people are worried about what their next term is. I mean, you could take a 10-year rate today at, in and around 5%, put this strategy into place, and you may be paying this off very, very quickly.
Absolutely.
Right? By increasing your payment 5%, 10% each year. You could eliminate a lot of the mystery behind the terms, which is what, this is really the interest rate exposure longer term.
Absolutely, and a lot of people don't, everyone wants to make lump sum payments and get rid of their mortgage. Everyone wants to do that. It's not realistic that Canadians will have a large lump sum to pay against their mortgage every year. We hope they do, but I think 3 or 4% of Canadians actually make the large lump sum. But these increases annually is a bit more of a disciplined approach, but they do work. The 10% example of $68 every 2 weeks, if you break it down, it's probably equivalent to about a $2,500 pay increase annually a year at a 35% tax bracket.
Your taxes, and then
So,
well, I mean, people have financial plans for their RSPs, for their RESPs, for everything else. Having a plan for your mortgage is something that's a little harder to do. So if your strategy was simply to increase your payment by 5%, start somewhere each year, then that saves you a lot of money to do other things with your life.
absolutely.
So that's this week's tip from MonsterMortgage.ca. Thanks for tuning in, and we'll see you soon.